Topic 12, it would be informal risk capital and venture capital. At the end of this topic, students will be able to explain the basic stages of venture funding, discuss the informal risk capital market, discuss the nature of the venture capital industry, explain the aspects of valuing a company and identifying the valuation approaches. Funding a new venture goes through many processes. Practically in a business world, we come to see the presence of many types of individuals and groups who help in sourcing money, especially to new and growing ventures. Any money market is a risk market because of the dynamics of the financial needs. Even very big reputed organizations at times fail to keep up to their promises in repayment schedules. So both the lender and the borrower understand the risks attached and go by the norms fixed. To raise money, ventures have to evaluate themselves to identify their worth in currency in the market. There are many approved methods adopted in valuing a company, and application of any one of such methods will make a company project an amount for its funding. The lender is also convinced that such a company with a certain worth can have a desired amount of repayment capacity. This will minimize the risks in borrowing and lending. Let us identify the stages of venture funding. While evaluating the appropriateness of venture capital financing, an entrepreneur must determine the amount and the timing of the funds required, as well as the projected company sales and growth. There are 3 stages of funding as the business develops. Early stage financing. It starts with the seed capital. It's relatively a small amount to prove concepts and finance feasibility studies. Startup. Product development and initial marketing, but with no commercial sales yet. Funding to actually get the company operation starting. Expansion or development financing. This is the second stage. The working capital for initial growth phase, but no clear profitability or cash flow yet. The third stage would be the major expansion for company with rapid sales growth at breakthrough or positive profit levels, but still a private company. The fourth stage would be to bridge financing to prepare company for public offering. Acquisitions and leveraged buyout financing, traditional acquisitions, assuming ownership and control of another company, and that comes under the category of LBOs, that is the leveraged buyouts. Management of a company acquiring the company control by buying out the present owners. Going private is another way of raising capital, and some of the owners, managers of a company buying all the outstanding stock, making the company privately held again. Informal risk capital market. The informal risk capital market is the most misunderstood and inefficient type of risk capital. It is a virtually invisible group of wealthy investors, often called business angels, who are looking for equity type investment opportunities in a wide variety of entrepreneurial ventures. Despite being misunderstood by and virtually inaccessible to many entrepreneurs, the informal investment market contains the largest pool of risk capital. The characteristics of informal investors could be the demographic pattern and relationship. They are well educated, with many having graduate degrees. They will finance firms anywhere in the US, and most firms finance within 1 day of travel. Majority expect to play an active role in the ventures financed, and they can also work in clusters of 9 to 12 other investors as groups. If you look at the track record of the investments, they range between $10,000 to $500,000 and an average investment of $175,000. And they normally make 1 to 2 deals per year. And the venture preference mostly would be startups or ventures less than 5 years old. And they are more interested in financing in manufacturing, industrial commercial products, consumer products, energy, natural resources, and services like retail and wholesales. They also have very valid reasons for rejecting a proposal when the risk-return ratio is not adequate, or the management team is inefficient, or they are not interested in a proposed business area, or when they are unable to agree upon a price. Referral sources. These angel investors generally find out about potential deals through referrals, like business associates, friends, active personal research people, investment bankers, business brokers, etc. Moving on to the nature of venture capital industry, it is a professionally managed pool of equity capital, and this pool is formed from the resources of wealthy limited partners. Some other groups like the pension funds, the endowment funds, the foreign investors, and a general partner manages the pool in return for a percentage of gain realized on the investment and a fee. They start in early stage deals and go up to 5-year period. Their investments are by way of stocks, debentures, and other securities. Venture capital process. It is the decision procedure of a venture capital firm, and the objective of the venture capital firm is to generate long-term capital appreciation through debt and equity investments. The objective of the entrepreneur is survival, whereas these two objectives are odds, so may end up in problems. So that care has to be taken. For that, the problems could be understood better if the following points are kept in mind. A venture capitalist should remember that the company in which they are investing should have a strong management team and have individuals who are solid with a very good experience and background, and there is commitment to the company, and there is capability in their specific area of expertise. They have ability to meet challenges and flexibility to scramble wherever necessary. The business opportunities also have significant capital appreciation. The venture capital process implementing these criteria is both an art and a science. Art because there is intuition, there is a gut feeling and creative thinking. Science because of its systematic approach, data collection, analysis and evaluation. There are 4 preliminary stages for venture capital process. The first preliminary screening would be the receipt of the business plan and evaluation of its approval or rejection. Next would be the agreement on the principal terms with the entrepreneur to negotiate the deal. Then comes a detailed review and the due diligence, a thorough evaluation technique with both internal and external factors. Then comes on to the final approval. A comprehensive internal investment memorandum is prepared and a formal legal documents are also prepared. How to locate a venture capitalist? One of the most important decisions for the entrepreneur is selecting which venture capital firm to approach. They specialize geographically by industry, size or type of investment. So through associations and directories, bankers, accountants, lawyers, these informations can be sought. How to approach a venture capitalist? It should be made in a positive and a professional manner. First, send a business plan with a short professional letter. Look in for the specialty in which the venture capitalist is interested in. When meeting the venture capitalist for the first time, meet with one of the key members of the management team and make a well thought out oral presentation. Following this, the venture capitalist may make initial investigation and initiate the proceedings. How to value a company? Factors of valuation, there are actually 8 factors that can be considered. The first one is the nature and history of the business. Second, to examine the financial data of the venture compared to that of the other companies in the industry. Third would be the book value or the owner's equity of the business. Fourth, the future earning capacity of the company. Fifth would be the dividend paying capacity of the venture. Sixth would be the assessment of goodwill and other intangibles. Seventh would be the previous sale of stock. And lastly, the market price of stocks of companies engaged in the same or similar lines of business. There are different valuation approaches. And the first one is the comparable publicly held companies, to compare a similar type of company with all related factors. Second is the present value of future flow cash, that is valuing a company based on its future sales and profits. The third one would be the replacement value, used only for insurance purposes, and it is the cost of replacing all assets of a company. Fourth could be the book value, using net tangible asset value, that is after considering depreciation and appreciation. Fifth would be the earning approach, determining the worth of a company by looking at its present and future earnings. The sixth would be the factor approach. Factors like earnings, dividend paying capacity and book value are used to determine the worth of the asset. Seventh would be the liquidation value, and it is the worth of the company after everything is sold out. So any one of these approaches could be found useful. Once this is done, a deal structure is made. It is nothing but the terms of the transaction between the entrepreneur and the funding source. When care is taken in structuring the deal, both the entrepreneur and the investor will maintain a good relationship while achieving their goals through the growth and profitability of the business. And in the process, this topic 12 has come to an end, and we'll be moving on to topic 13. Preparing for the new venture, launch, early management decisions. Thank you.